Hi, this is Leanne Monk with the Platinum Group Real Estate Team at Pearson Smith Realty. I'm here today with my lender, Betty Connell, and we're going to be talking about mortgage financing. So Betty, before we begin, would you mind telling us a little bit more about yourself and your company?
Sure. My name is Betty Connell. I work for Home Savings and Trust Mortgage. We are a local mortgage banker here in Northern Virginia, and we do actually fund all of our loans. So you would be working with our team and our company from the processing phase all the way to closing. We will be funding the loan and working with you through that whole process. Home Savings and Trust has been in existence for 28 years. And we do service all the local, real estate transactions that are brought to us.
So Betty, talk to me a little bit about the advantages of a local lender such as yourself versus an online banker or even a nationwide banker where they might have different locations for different parts of the team that actually prepares the loan.
Leanne, I feel like it is the best of both worlds with our company because, as I mentioned before, we do fund our own loans, but at the same time, we have multiple banks that we have relationships with. So I have the opportunity to shop the interest rate for the borrower, and that can vary quite a bit from day to day, sometimes from morning to afternoon, which bank is priced more competitively than another bank. So I will choose the best interest rate for the borrower when it's time for them to lock in their interest rate. We also have in-house underwriting, which is so important. The loan doesn't go anywhere out of our particular shop, as we call it. So the underwriting is done in-house, which is important because that underwriter is familiar with the local area where we live, which is a huge advantage. In the market that we have right now, as you know, it is a seller's market. And there are most likely competitive offers when the buyer is presenting their offer. And as a listing agent, the seller's agent, that agent is going to be perusing all of these multiple offers. And one of the things that stands out the most as a positive is if the lender for that particular transaction is a local lender, because that listing agent representing the seller knows that that person's reputation means more than an online company or an out-of-state representation, which is more like a one-shot deal for that particular person. So it puts the buyer in a better position for negotiating if they have a strong local lender that's representing them. So an underwriter is the one ultimately signing off on the approval of your loan. Initially, I work on the pre-approval. And I do that based on my experience in running all of the debt to income ratio and all of those things that come into play with approving a loan. But ultimately, the underwriter is the one that's signing off on the loan. And it's important to have a good team member like that because, like I said, you can go back and you can have a back and forth conversation with the underwriter to come up with creative solutions for making things work. If you don't have that, if let's say it's an internet lender or someone who is representing a bank locally, but they're really servicing the underwriters and all the servicing centers are in a completely different state. I did work for a company like that for a very short period of time during my career, and I can tell you it was a nightmare. As a loan officer, much less the poor borrower, because there's always a time lag with communication. You're sometimes in a whole different time zone. These banks are, and there to them it's just an electronic file that they're looking at on a screen, and when they get to it, they get to it, and so there's the processing time takes a lot longer, and you're also left in limbo, which is not a good feeling to be in when you're in the middle of a process as important as this. I can actually walk into my underwriter's office and have a conversation with that underwriter. And it's very personal then, you see, because I can personally tell their story or whatever it is that we're trying to get through, and work directly with her to come up with a solution. So like I said, it's personal, and that makes a huge difference.
Betty, I think a lot of people are really familiar with the term pre-approval process, but let's explain that a little bit more and why it's important for number one, the buyer to get that pre-approval, and what you do that I think is a little bit unique in how you gather the information to get that pre-approval in the first place.
Leanne, I find that, especially with first-time home buyers, it is such an intimidating process. It is for anyone, but especially for first-time home buyers. And I think that that keeps a lot of people from jumping into the buying process because they are so overwhelmed with they have to be perfect. Okay. And so the pre-qualification process, it's important for me to put them in a position of feeling empowered with the information. The process, the pre-qualification is a requirement really for being able to write a contract, because when you write a contract, you have to present a letter with that contract that says that that particular borrower has been looked at and that they do qualify for this transaction financially. So the beginning process is applying for that. And what I do personally is I take that information over the phone from the borrower, because this is a story that we're trying to tell to an underwriter that ultimately will be approving the loan. And that story, it cannot be fit into little boxes on an application on an online screen. I mean, that's a good starting place, and some people really prefer to do that, and if they do, I allow them to do that, of course. But I find that it's better to start a relationship through this pre-qualification process, because it gives me an opportunity to gain much more information from the borrower that helps me to assist them in guiding them through the process and determining the best options for them. So I will be taking information on income, employment, where their assets are in the form of checking, savings, that sort of thing. There are three basic components to qualifying that we're trying to gather information for, and that is income, assets, and credit score. So it's all part of a puzzle, and we're trying to fit those pieces together for each individual person, because it is so individual. And that's how we want to approach the situation.
In addition to knowing what they can afford in terms of a sales price, I think it's also important for buyers to understand what that monthly mortgage payment is going to actually be. How does that factor in when you sit down with the client and walk them through all the different loan options?
So what I do for the borrower is I kind of build a spectrum of sorts. So I always ask, what is your comfort payment? And that's what you're talking about. What are you going to be comfortable with right now based on your budget and how you're feeling? And then I turn that into what that buying power is. What does that create? And I tell them that answer. But then I also tell them the maximum that they qualify for. And the reason for that is so many times people set a goal for themselves for their comfort payment, and it's going to fall short of what they ultimately need to spend to get what they want or the area that they want and that sort of thing. So that's why I show that full spectrum. So when they're out there looking and they start with what their comfort payment creates, and that's falling short of what they want, then I give them the tools, the cost per 10,000, to be able to adjust off of their comfort payment to create a higher sell price and maybe bump up their price a little bit, because $25,000 can make a huge difference in the type of dwelling or the size or the location. And $25,000 only equates to about $125 in a mortgage payment. So when they see that, that's a small difference to bump up a price. Sometimes they'll come off of their comfort payment to get what they really want. And the other thing is, usually people that are determining what they are comfortable with now is based on usually, say, someone who's renting, for example. And that's a whole different ballgame, because when you're renting, first of all, your rent is going to continue to go up, whereas your mortgage is locking in your housing cost, aside from minor changes of real estate taxes and insurance. And so what's happening there is that because your mortgage payment is staying fairly constant, unlike rent, your income is going to be going up. So as your income is going up, but your housing cost is staying the same, that gap will become less and less of a burden. And that payment that you're trying to push yourself on a little bit out of your comfort zone to get what you really want will ultimately not be as threatening to you. So unlike rent, where it's going to keep going up and maybe even staying in line with your income. So that, coupled with the fact that you're getting a tax write-off. You're not getting that now, but on a mortgage, you will be able to write off the bulk of your mortgage payment because it mostly consists of interest and real estate tax. And because now you would be getting this tax write-off, which I go into much more detail with the borrower when I'm talking to them, but I won't take up the time now. But that combination of getting this windfall of tax savings, coupled with the fact that your mortgage payment housing cost is staying consistent, is going to bridge that gap very quickly for them. So it's important to know that full amount and not be stuck just on the comfort payment.
So what are the various steps in the loan process?
So, Leanne, the first step is the pre-approval process. And that is where I will gather all the information, financial information from the borrower, including documentation for pay stubs, W-2s, bank statements, things of that nature, supporting documentation. I will have them upload that into a secure portal where I will review those documents in addition to taking all of their application information and spending quite a bit of time with them, finding out about their needs and wants and kind of what their goals are. So once that process has started, and I'm able to determine that they do qualify, and yet we have another whole conversation laying all that out for them. They're ready, they're educated, they're empowered to get in the car with you and start looking at properties. Okay, that's where we want to get them, to that point. So when they're starting to look at properties with you, they already have their financing completely understood. And you have to be there. You have to be there mentally to feel comfortable and confident enough to write a contract. So then they're just looking for their next home. And at that point, once the contract is ratified, which means that the seller and the buyer have come to terms and everyone has signed off on all of the final paperwork for the contract, then what we do as a lender is we move into the more processing end of the spectrum. And so at that point, what's happening kind of behind the scenes is we will order the appraisal on the home, which is the appraiser will go out to the home, determine the value. It's a full 25-page report that the buyer will ultimately get as well. And the buyer will be ordering their homeowner's insurance. So they'll be doing that behind the scenes. And then once we have the appraisal in, we're going to submit that whole package to our underwriter. The underwriter then will review everything, checks and balances, and sign off on the loan. And then the loan goes into something called the closing department. So the closing department is the one that's going to be interfacing with the title company. The title company, in turn, is the entity that's going to be presenting or representing the buyer and the seller in the settlement transaction. And so our closer will be coordinating everything with the buyer's title company and preparing all the final legal papers for settlement. The settlement itself, which you'll also hear the term closing, will be the final meeting of everyone to sign the legal documents, and that's when your buyer gets the keys. So hopefully that will give you some kind of idea of what to expect.
Now, most people realize that your credit score is an important component of the loan process, but sometimes I think people think it's the only thing. Can you talk to us a little bit more about that, please?
First of all, you do not need 20% to put down. Where that 20% comes into play is that if you're putting 20% down and you're using a conventional loan, then you do not have mortgage insurance to be charged as part of your payment. But most buyers, whether they're first-time buyers or not, do not have 20% to put down. So the mortgage insurance is a nominal amount, truly, that allows you to be able to put a minimum down. And it is something that ultimately you can drop. So it is just kind of bridging you to getting into home ownership. But there are programs for first-time home buyers especially that you can do 100% financing on, or you can do a 3% down payment. Where there are programs that would allow a grant to even subsidize that 3% down payment by giving you a 2% down. So do not let that hold you up from venturing into this process, because there are possible programs that you can fit into that will offset that. So a credit score is a key component to the home buying approval or the mortgage process. It's one of the top three. And so it is an important piece, but at the same time, there are loan programs that will allow for credit scores as low as 640. Now, the higher the credit score, generally the better interest rate one gets and the cheaper mortgage insurance premiums are. But there are programs like the FHA loan that is more accommodating for the credit score being low. So in a 640 credit score, or truly anything under 700, we would typically look at the FHA loan for that buyer. And the reason for that is because the interest rate is not predicated upon the credit score itself. So if someone were to have a 640 credit score or a 680 credit score, they're still going to get the same interest rate, unlike a conventional loan where that can adjust the interest rate. And also the mortgage insurance is a fixed amount for the FHA, rather than on a conventional loan. If someone has a very low credit score, their mortgage insurance premiums can be quite costly. So we will pick the product that fits the credit score. And if the credit score is not in a range of being acceptable, then I will help work with them on getting that credit score, just take a look at and see if there's something that we can do, that I can advise them to do to repair their score.
Betty, it feels like sometimes people are hesitant to talk to you as the mortgage lender because they're not quite ready to buy and their actual time zone to purchase is a lot longer. What do you say to folks like that?
That's a great question too, Leanne, because it is never too early to start this process. And I love the quote, begin anywhere. And that applies so perfectly here, because a lot of times you need to plan. If someone has a possible credit issue, then we need to fix that. We need to figure out how to fix that. And I need to set up a game plan for that person so that we can set them on some kind of time frame to accomplish getting that rectified. Also, it's important to understand how much cash you're going to need for the transaction through down payment, closing cost, and those sorts of things. So it's an educational process, and it's never too soon to be educated. So I think it comes down to the intimidation factor that we were talking about earlier. And I think that's what's sometimes holding them back from getting started. But I welcome anyone to just say, let me know where I stand right now. And I'm not ready for a year to buy a house, but I just want to have a baseline, just like anything else. And have some goals to be able to set to accomplish purchasing a home.